What's up there YouTube? Welcome to my channel. This is the Frugal Investor. In this video, I am going to give you guys a fundamental basic analysis of ART's stock, ART's ticker symbol UTZ. Please don't forget to like and subscribe to the channel. Click the subscribe button and like, thumbs up button. With that said, let's get right into it. ART is a company that makes chips and snacks. So it is primarily focused on snacks and chip business. Some of the most favorite products of Arts are the Red Hot chips, the crab potato chips, the ripples, the cheese balls. My personal favorite is the cheese balls. I buy them all the time. Whenever I'm watching a video or I'm watching Netflix, I dip into the big box of cheese balls and I love them. So they're basically a snack company. When I am doing a fundamental analysis of any dividend stock, I look at certain metrics that I judge the company by. The metrics that I look at when I'm analyzing a dividend stock is number one is business. What kind of business the company is doing? How big of a market cap does the company have in that space? Arts is in the snack business. So we're going to look at how much is the market cap, what percent of change of it Arts owns, how well spread is the business. Second thing that I look at is the balance sheet and the financials. What does the numbers say? How much cash does the company have on hand? What is their revenue stream? Is it growing year over year? Those are the things that I look at. The second thing. The third thing that I look at is leadership. Leadership is who is the CEO? What kind of experience do they have? Is it family managed or is it directed by a board of directors? Those things matter a lot. That's one of the most important points when you are analyzing a business because the leadership is what determines how the company is managed and in which direction the company is going. And if it goes through a bad time, how is the leaders equipped to handle those situations? The number fourth thing that I look at is the performance and growth. How well has the company done over the past 5 years, over the past 6 years, and how well are they performing now? Is the revenue growing? Is the top line growing? Is the bottom line growing? And the fifth thing that I look at is the P by E ratio. P by E ratio is a very important metric. So P by E ratio and forward P by E ratio. P by E ratio, generally, I'm looking for a snack business or a business like that. I'm looking for a P by E ratio of somewhere anywhere from 12 to 24. That's a safe zone to be in. Those are the five metrics that I look at when I'm analyzing a business. And if all those five metrics are met, as I'm going to tell you in a bit, then it's a great business to buy. And if you own it, it's a winner. It's a winner because it is in a very safe position. Let's take a look at Arts. First metric we're going to look at is the business. Arts is a snack food company. They have a lot of products on the shelves in gas stations and in grocery stores, like the cheese balls, like the Arts Ripples packet, like the Arts chips, the potato chips, which is the most selling product. Now, as we all know, snack food business is there are a lot of big players like Nestle, like PepsiCo in this space already. So we know that Utz is not the leader in this space. It can be the second or the third biggest player, but it is not the leader in the space. It has a good business. It has a very solid business, a solid product that people love. It sells a lot. The current market cap of Utz is 2.01 billion, and the snack food industry in the United States is 15.8 billion. So Utz is about 13% of the current snack food industry. It is not one of the biggest players, as I said, which is not a really great point because when you are buying a business, you want it to be the leader, the first in the business, the biggest player in the business that has the most market cap, because that is a huge moat for a business to have, which Utz doesn't have. But that is not just the only point that is going to make this business or not buy. We will look at certain other points. We know that it is one of the most selling products. It is one of the most selling chips. It has really great chips, really great products. People love those products. So that is a really great point. Second thing that we're going to look at is their balance sheet and their financials. First thing that I'm going to look at in this case is how much debt, total debt they have. So in this case, Utz has a total debt of $762 million. And the amount of cash they have on hand is $4 million. Now, that is a very unsecure position to be in because that is a lot of debt and the amount of cash they have on hand to cover that debt. If something goes south, the company will be in trouble. If we look at their top line has been growing significantly from 772 million in 2018 to 964 million in 2020. Within the year 2019 to 2020, they grew by almost 14%. And in the year 2021, they are expected to grow by almost 22%. So it is a highly growing business, which is a really great point. And as we will see at the P by E ratio, it is trading at a P by E ratio of 33 as of today, which is a very high P by E ratio. But that justifies that because it is so growing so fast and it just IPO'd last year. That's why it is available at such a high P by E ratio because it's a high growth stock. If we look at their bottom line, the company is losing money. In 2018, they were losing $30.5 million per year from their profits. And in 2019, they lost 16 million. And in 2021, they're losing $96.5 million. So this is not a profitable business. But there is a reason. There is a reason they are losing this money. The reason is they're acquiring companies. They are growing, they're expanding, they're acquiring companies. They just acquired On the Border Chips, and they also acquired a company which is called Truco Enterprises. So that explains why the company is losing money, and that also explains why uh, why they have so much debt, because they have been accruing that debt to acquire those businesses. So that is why the company is in a financial state they are in right now. But their top line is growing. So that means they have a lot of room to, once they stop acquiring those businesses and they start focusing on the business more, on their primary business more, they are going to be profitable. So that is a really nice point. Right now, they're focusing their money and energy on acquiring new businesses. They're accruing a lot of debt, but their top line is growing. That shows that either today or tomorrow, they will be profitable and they will start making money because of their increasing top line. And now they're acquiring those businesses, which increases their outreach in the market. So it is going to be profitable, but it is not profitable as of today as we are talking right now. So now we looked at the business. The business is solid. The product is good. They are not the leaders in the space, but they have a really good product and they are expanding. Balance sheet and financials, they have a lot of debt. They don't have a lot of cash on hand. Their top line is growing very, very fast, almost by 22% per year, which is a very high growth number. But we have to see if they can sustain that. And their bottom line is also growing. They are now losing less money as compared to before because they're acquiring new businesses and they're investing into their business more to grow it more. Now the third point that we're going to look at is the leadership. If we look at their leadership, the company is mostly family owned business. It was started by Utz family. Their daughter Arlene Utz and her husband, who got the business from Arlene Utz's parents who started it, then became the CEOs of the company. After now, it's being still being managed by the third generation of the Rice family, Michael Rice. Michael Rice still sits on the board of directors, and his son-in-law, whose name is Daniel, is the CEO of the company. So it is a very much a family-owned enterprise. Now that is a really great point when you're buying a business, because family-owned enterprise, they have their hearts and their souls and their hard work and their their family's name on the line when they are managing this business. So it is they are going to do much better than a board of directors who don't care what happens with the business. If things go south, family-owned business have more chance of recovering and doing better in the long run as compared to a board of directors. That is a really great and positive point for Utz. Now, the fourth point that we're going to look at is their performance and growth. If we look at their growth in the past years, as I told you, they are losing money because they're acquiring new businesses. They just acquired On the Border Chips and Truco Enterprise, but they are growing. Their profit margins are growing. In the first quarter of 2021, Their sales were up by almost 7% as compared to the previous quarter in the previous year. So they are a fastly growing companies. And that is why it justifies the high P by E ratio, which is 33.37 that the company is trading at today, because they are growing so fast and acquiring new businesses and expanding and investing back in their business. Their profit margin is 8%, which is a solid profit margin. It's not a bad number at all. From 2019 to 2020, the company grew by 14%. And in 2021, they're expected to grow by 22%. That brings us to the next point, which is the P by E ratio. The P by E ratio that UTS is trading at today is 33.37. Now, this is a very high P by E ratio. We are not looking at a company in this high P by E ratio for a snack business. But the thing is, Arch, they're acquiring new businesses. They're growing at such a high rate, which justifies this P by E ratio. They started IPO last year. In 2020 is when this stock started trading. So it's still a new company for the shareholders. And their forward P by E ratio is expected to be 29.2. So this high growth company, which pays out a dividend, and it has a P by E, and it does not have a very high payout ratio, and it is acquiring other businesses, it is still family managed, and it is has a huge room to grow in the snack industry itself within the country and internationally. That justifies this P by E ratio. That justifies why they are trading at such a high number. Currently, the stock is trading at $23.36. Within the past year, they're up by almost 70%, 70%. Now, that is a huge amount of growth that the company has seen in just 1 year. Why are people ready to pay this premium for this company? Because right now they're not profitable, they're investing more, they're buying more businesses, but it is a solid product. And people know that, and they know that this business will be very much profitable when they start investing more in their business and they start, their top line is already growing, and when they start taking some profits home instead of investing it in buying other businesses. Currently, they are paying a dividend of 16 cents per share, which is 0.67% dividend yield. The payout ratio is 22.41%. So there is a lot of room for that payout ratio to grow as well. And they pay out their dividend quarterly. That was my analysis of this company, Arts. Now, in my opinion, this company right now, I am not buying this company right now. Now, I'm not a financial advisor, and this is just my opinion. I'm not buying this company right now because I think it is available at expensive price. I need to see more results. I need to see more better management, more cash on hand. I know they're acquiring businesses and they're growing so fast, but I need to see more results and more better management. They just started trading last year, and I'm not in a hurry to buy this company. I know they will be growing and they will be paying out more dividends, and the dividends will be growing and they'll be more profitable, and the stock will be trading at even a higher number in the future, but I don't mind that. Right now, it is not a business for me to buy, but in the future, I'll keep looking at this business. If their bottom line grows, the top line grows, and they have more cash on hand, less debt, and they keep innovating, they keep bringing out those products, and they keep selling the same amount of numbers and keep having the solid growth that they are having. Now, this year they're expected to grow by 22%. That is a very solid number for a company to grow by. So if they keep seeing this growth, they keep the family management in place, I am a buyer for this stock, but not right now. And the reason is their high P by E ratio and the amount of debt they have on hand. So that was my basic analysis of Arch stock. The things that I looked at while analyzing the stock is the business, the balance sheet and the financials, the leadership, their performance and their growth, and the P by E ratio. Okay, so those are my 2 cents on this company. Please let me know in the comments down below what you guys think. Thank you for watching, and see you in the next one. This is the Frugal Investor. Don't forget to like and subscribe.